Yes, you are listening to the Ready, Set, Retire radio podcast with Steve Anzoni. My name is Jessica Forkel. Get more details on the website at fairwayfinancial.net. As if you don't hear his name enough, the Trump tax cuts, guys, they are ticking down because they are about to expire at the end of next year. And if you want to take advantage of lower tax rates now, you can do that with a Roth conversion. The money goes in after tax. But tax guru Ed Slott, he tells Morningstar that many people are skeptical because then they think our friends, again, at the government are going to backtrack here and try to tax Roths. Listen to this.
I'm going to give you the secret that Congress doesn't want anybody to know. Don't worry about it. Congress loves Roth IRAs. I mean, loves, addicted, that kind of love. It brings in money. It helps pay for everything else. So luckily for us, they're so short-sighted. Remember, the only money that can get in a Roth is already taxed money. So they look at the Roth IRA as a revenue source. So I don't think they're going to kill their golden goose.
Interesting. Lots of information there I want you to unpack. First, I want to know, do you agree? And then I want to know how much of a retirement nest egg should be converted to a Roth before 2026?
Well, Ed Slott is one of the most smartest people I've ever had the pleasure of meeting and attending his seminars. He is brilliant. He's a CPA. He's on public television a lot, does these shows. He's got books and all kinds of stuff, which I own a lot of. I have a deep respect for him. And if he says that, I'm going with it. I'm going to believe it. And he's right, because it is a revenue stream for them today to use to pay off other stuff. Because these people, they don't know how to budget to save their lives. And any money they can get today, they're going to take it and they're going to use it in a terrible fashion, but they're going to have it to use, and it's going to keep them in office another year longer. Mm-hmm. So I agree with him 100%. But having said that, it's still an interesting opportunity to do because Roth IRAs are tax-free. Isn't that just a beautiful word?
I love it.
IRAs and traditional 401ks are tax-deferred. So it means someone's going to pay down the road, and that someone is us, right? So, yeah, it makes sense to do some conversions if you're in the right tax situation, and if you have other liquid assets that you can pay the taxes on. So you don't want to use the monies from the rollover to pay the taxes, because then you're cutting that pile down. So you want to take, let's say, $100,000 from a regular, convert it to a Roth, and then if the total tax hit is, say, $20,000, you want to use that from other sources, so the full $100,000 goes into the Roth and can grow tax-free. That's the right way to do it, I feel. And, that's how you can maximize your return and your tax-free income down the road. Now, it's not as easy as that because, well, think about it. Anytime you deal with the government, nothing is simple and that easy. And there are some taxes involved, and you got to figure out what tax bracket you're in now, where you're going to be in the future. So you got to have a conversation with your CPA to say, hey, just because tax-free is beautiful, does it mean, that I'm a good candidate for it now? Should I wait a year or so? But like you just pointed out, those Trump tax cuts are sunsetting the end of 2025, which means they go away automatically. Okay. So that's a consideration too. Of course, unless, if Trump wins, then, all bets are off and maybe he'll keep the lower brackets.
Right.
But you just want to do your homework on these things. I think they're great. And by the way, you can do, if you're still working, you can do Roth 401ks, right? So you could put your money in after tax into a 401k too. So that's another consideration. Is to maybe change the way you're saving for the future, right? I'm a big bucket guy, right, Jess? And so I like to create different buckets of wealth. And so I have a Roth 401k, and I also have a pre-tax 401k. So I have piles for different reasons, and if I can control the taxes in the future and keep the taxable pile down, I don't mind doing that a little bit because you do get the write-off today. So everything's balance in life. That's the key. And also talking to somebody who's intelligent enough to be able to have, the knowledge to talk to you about what you should do. And that's important too. Don't just guess at it. Talk to someone who's been around, who knows what they're doing, and that'll help you too. I just had a great meeting with a couple who listens to the show quite a bit, and they came in earlier this week, and we had a great conversation, and I gave them some ideas and some tips about adding more to their 457 plan. In this case, they work for the town of Falmouth. So we're going to up their contributions. Otherwise, they're doing pretty well. They're in decent shape. They have no debt, which is wonderful. Right, Jess? That's the key.
That's huge.
We can help you.
Well, Steve, lots of folks speculating about Social Security, right? We've been talking about it for a long time. Is it going to be around? 2035 is where folks say it's going to run out. So what does that mean for our financial future? Well, I saw an article that said, with the problems with Social Security, that if nothing is done, benefits will be cut back by 25% in the year 2035. And, of course, nobody wants to tackle this right now. They kind of want to put it on the back burner. And they say that if you wait till 2035, it's the same as basically trying to change the course of the Titanic after it hit the iceberg. And we all know how that turned out. Not great, obviously.
Not good.
So it'll be too late. So if Social Security is going to be diminished by 25%, or if it goes away completely one day, what are we supposed to do? How do we fill that gap, and how can you help?
Well, a lot of it is true with regards to financial numbers, but the reality is that it can't go away because too many of Americans depend on it as part of their retirement plan. So unless there's a replacement plan out there that's going to be put in place, Social Security is going to be here for a long time. The reason it's burdened and so cash challenged right now is because our government is stealing from it to pay for other programs. That's a fact, and that's the bottom line. Of course, they call it taking a loan, but it's a loan that's never going to be paid back. Now, I feel that they do have a rich benefit on one of the pieces where if you wait till after full retirement age, between that age and age 70, it's going to grow at 8%. Well, that's a pretty generous growth factor, to be honest with you. So I could see that being cut back to 4, and I could see capping some of the Social Security a little bit, but it's not going anywhere. But it is dangerous to think that from a pure numbers standpoint, it could technically be bankrupt in 2035. That's true. And if they do wait till 2035 to say, oh, we need to do something, then you're right. That Titanic comment is absolutely right. The problem is these people they just can't get out of their own way. They just keep putting off future problems to the future, and they don't want to tackle the numbers now. And we need somebody to step up to the plate and to do that. So that's the key. And I don't know who that person's going to be. I mean, I don't think it's going to be Joe Biden. It could be Donald Trump.
Yeah,
it could be. He could be that type of guy to attack something like that. But the challenge is that the Congress and the senators, they don't participate in Social Security, Jess. Mm-hmm. So really, the only reason why they sort of care about it is because it helps them get elected. It doesn't affect them personally. They have their own mega pension plan. They have their own mega health insurance. Mm-hmm. So they just, put on a smiley face and talk about how important it is. But they need to do more than put a smiley face on. They need to take pen to paper and get something done, okay? Because it's really a disgrace that this system, which had hundreds of billions of dollars in it in the 80s, is now in trouble. And again, the only reason why it's in trouble is because our Congress and senators, quote unquote, borrowed from it to bail out other programs that were not funded correctly either. Well, I shouldn't say either because this was funded correctly. And if you think about it, when it first came out in 1935, people were supposed to die before they even collected their first check. Mm-hmm. So yeah, it was well funded. But obviously, seeing such a rich basket over there was just too tempting for our folks in the White House, and they just couldn't resist. So, I have a lot of clients who are concerned about that, and I don't blame them. I have a lot of customers that say, look, Steve, I'm taking it at 62. I don't care. I don't trust them. and I don't blame them. Or I'm not going to wait till I'm 70. I know it might make sense from a pension standpoint, but I just want the money now, right? And I could see that. This is a dilemma. And if you're kind of one of those folks, and there's a lot of them out there who are kind of puzzled, Jesus, do I wait? Do I just take it now while I can? You're not alone, all right? Give me a call at 508-552-3230, and we'll have a discussion about it. We'll run the numbers today. We'll see what they might look like in the future, and we'll look at alternatives. You just got to, you too out there have to be proactive about this. You have to say, if you're worried about it, don't just say, I'll worry about it when it gets there.
Mm-hmm.
Don't do that. Don't make that mistake, because that's what got us in trouble. Be proactive. Give us a call at 508-552-3230 or visit the website, fairwayfinancial.net. Get on there. You'll see a tab. You can click a tab, make an appointment, even on the phone, or if you want to come in, great. But you got to have the talk now, because once you turn the check on, it's irrevocable and you're done. So this could be a $100,000, $200,000 mistake that you could make with your Social Security. So don't be one of those folks. Be proactive, get the right information, and make a good decision about it.
Hope you guys are enjoying your summer out there. I'm sure there's lots of family get-togethers, vacations, and more travel. And, you might be thinking, well, I'll handle the finances when I get back. Well, I came across an article that says that before the year gets away, summertime, so right now, is a great time to have that mid-year financial checkup. So, Steve, what are some items off this checklist that we need to be aware of?
Well, I just had this conversation, right, with that couple that came in, right, about reevaluating your retirement contributions. Do you know the numbers? Do you know that if you're over 50, you're allowed to kick in a whole bunch more money, over $30,000 a year? So that's one thing. Are you withholding properly, or are they taking too much taxes out of you? If you're getting a massive refund back, it shouldn't be cause for celebration. You're losing the interest on that money. And now, since banks are paying interest, that could add up to a lot of money. So just make sure the withholdings are in the right area so that maybe you get back, maybe $1,000 or $1,500, but nothing crazier than that. You want to look at where your allocations at, and in your 401k, you got to look at the term, where you're at, how old you are, how many years you have left to work, not on this earth. Just to be clear,
right.
We don't know how many years we have left on this earth. So just check them. If you were super, super aggressive 10 years ago, and obviously you're 10 years older, maybe you want to get more moderate, but something like that. But don't get overly analytical on here, because a lot of the stuff that you're in is probably diversified a lot as it is. The biggest thing is to be putting away a good chunk and doing it systematically and taking advantage of dollar cost averaging and all that sort of stuff. That's the key there. And then your estate plan. And I know people think, well, I don't have a big estate. I'm not even worth $1 million or $2 million. That's not necessarily what it means. An estate plan can just be making sure that your money doesn't go to probate. That could be an estate plan for somebody. Or it could be as complicated as someone with multiple companies and properties. But don't think of it as, I only have a house and 401k and a few things. Make sure those are in order. Make sure that they avoid probate, that your beneficiaries are up to date. I've seen people come in and they're showing me their plans, and I'm like, oh, okay. And I see these names on there that don't match their names.
Oh, boy.
And so I'm just curious.
Yeah.
Well, it could be a niece or someone else. I get it. But I just throw it out there. And people are like, oh, yeah, I forgot to change that, or I forgot to do this. Well, don't get stuck doing that, because your money could go to the wrong person. And you really won't have much of a choice after the fact. That's the big problem. So your intentions are irrelevant when it comes to having that money go somewhere. Whoever's name is on there is going to get it. So, that's just the stuff that I see. That's the common stuff. Might be some other things, but the real key is just look. I said it earlier. Just be proactive. Don't just sit there because, it's summer, it's 90, it's 100 degrees. I'm just going to chill. Which is cool. That's what the Cape is for, right? To chill out a little bit. But it's also a good time to maybe make a phone call, see where you're at, because there's a lot of stuff coming up, the election, there's a lot of things going on in this world. Inflation is still here. It just is what it is. And are you in the right place? Is your money working for you the way it should? That's the bottom line.
Get more details on the website, fairwayfinancial.net. That's fairwayfinancial.net.
Steve Anzoni is a licensed insurance provider by the Division of Insurance and is not registered as an investment advisor. Insurance and annuities offered through Steve Anzoni, Massachusetts Insurance License 3851053. Annuity guarantees rely on the financial strength and claims paying ability of the issuing insurance company. Read your contract for restrictions, limitations, or penalties. Steve Anzoni is not licensed in all 50 states. To find out if Steve Anzoni is licensed in your state, please call 508-398-3337.